So our IULs, or Index Universal Life Insurance policies, do they work with infinite banking too? Are they compatible with infinite banking? You've probably heard people say like, oh, I want to get this indexed whole life insurance policy. Well, first off, there's no indexed universal whole life policy because that's two different things. So I'm going to explain the difference between the two of indexed universal life and whole life and what the differences are with when you try to use this with infinite banking. All right, so first and foremost, let's just get right into what are the difference, right? Now, everybody's usually heard of term insurance. Term insurance is just death insurance. You pay a premium, it's kind of like your car insurance. You pay a premium, and then when you have to use it, it gets used. Unfortunately, with term insurance, you never get to see that benefit because you have to die for you to get the benefit of the term insurance, right? It's just death insurance. That's all it is. But life insurance, shouldn't it also have life involved with it too? Shouldn't it be life insurance? Well, that's where you get into these other types of insurances too. And there's really two main categories. There's universal life, and then there's whole life. And then there's a lot of variations from there. But you got universal life. So universal life is really like buy term and invest the difference. It's funny because I hear a lot of people say, oh, universal life is horrible. Don't ever get it because you can just buy term insurance and invest the rest, right? And that's a strategy you can use. But what they don't realize when it comes to universal life specifically is that universal life is literally just term insurance with a cash savings component to go with it. Now, here's what's funny, guys, is that it's like a term insurance that renews every year. So the one thing that's a little bit risky with universal life is that it gets more expensive every single year. Because every year you get older is the year that you are more likely to die, right? So the more likely you are to die, the older you get, the higher the costs become. Just like term insurance where they lock it in for a time, then it gets more expensive over time. Oh, by the way, here's another key point that's a kind of a bonus tip for you. Term insurance, when it gets to the point of renewal, can get very expensive. In fact, it's the most expensive insurance later in life. It's not financial experts, it's the insurance companies that taught financial experts to teach you that you should cancel your term insurance when you get older. Why? Because they don't want to pay out. They want to take all that money in as profit on that term insurance. You pay those premiums for 20, 30 years, and then when you're most likely to die, they want you to cancel it so then they don't have to pay anything out. That's literally, they have stats showing that over 99% of term insurance policies never pay out. They never pay out in the death benefit because they teach you to cancel it first. So just be aware of that. But with universal life, there's kind of a similar factor that happens as well. Because term insurance gets more expensive over time if you're not careful. And if it's not designed well, what could happen is that eventually it'll eat itself alive. The insurance costs will get more expensive than the interest you're earning. Because universal life can earn money in three different ways. There's three types of universal life. There's plain old universal life, which just usually pays a very low rate of return right now. It's certain, but it's a low return. There's indexed universal life, which kind of is like a hybrid of the stock market. It can give you some of the market highs, but it caps you a little bit. But you also don't get any of the stock market drops, right? That's indexed universal life. And then there's variable universal life, which is completely in the stock market, right? In that place, you can make money in the stock market, all the gains, but you can also get all the losses. That one right there, that variable universal life is the most risky one. And if you have some bad market years, you can find yourself in a place where you're throwing in more money than you were promised to do in the first place. You've got to be careful with those. I actually know because I used to sell those things back in the day. And those are very risky, especially when there's a down market. So what most people have been promoting lately that you hear more and more about are indexed universal life. Now this one, like I said, it has tied to a stock market index like the S&P 500, but they'll put a cap and a floor. So they might have a floor of like 0 or 1% that you can't make less than that, but they'll also put a cap on you. Usually that cap is between 8 and 10%. So if the stock market does 6%, that index does 6%, you'll make 6%. If the stock market, the index does say 20%, you get capped at that 8 or 10%. But if it goes down, say it drops 20%, you still earn 0 or 1%. It sounds great and it's awesome in some ways. But I learned this firsthand when I was actually working as a financial advisor. I was selling these in the early days before they got popular. And I remember I was training some younger insurance agents about it. And when they say, well, what about this, Chris? Like, what if the market does go down for a few years? Does that ruin the numbers? I'm like, oh yeah, I guess so. Because you say even if you earn 0% on that money, so the market loses money, you're grateful you didn't lose money, but it's at 0%, but still insurance costs are coming out, you still technically lose money. Even though the market didn't lose money, you still lost money because of those insurance costs pulling the money out. So you could actually watch your values drop and get dangerously low. The other thing too, they would say, well, yeah, well, it's term insurance basically, right? Just term insurance and then investing the rest. Well, that term insurance gets more expensive over time. What happens if you're older and you don't quite get the same market returns? And we run different numbers and we're like, ooh, that doesn't look good. If I don't show you a high return, it doesn't look as sexy anymore, right? In fact, it's possible that by the time you hit your 70s or 80s, that insurance is gone without you having to pay a lot more money into it. So you might literally have to pay into it the rest of your life, even though we would teach people you could pull out money for retirement. But if you try to pull out money for retirement and those costs are going up and the markets aren't going up as well, you could actually find yourself in a place where you have no cash to pull out anyways. So that's one of the big risks with index universal life. That's why when people say, is it compatible with infinite banking? Yes and no, there are some risks. But here's the number one reason why it's not compatible with infinite banking. Although you can still borrow from it and you can use it to invest, one thing that the vast majority of index universal life, there's about 1% that does have the exception here, but the vast majority of them will not let you make money in two places at the same time. If you borrow from index universal life, guess what happens? They'll charge you interest, right? But then they'll credit you back interest. Sometimes it's the same interest, but usually have to wait so many years before they finally match. And they call it what's called a wash loan, or like a 0% net loan. So let's say that they charge you 5% for that loan rate, but they'll also credit you back 5%. Well, they'll just say, well, it's basically a 0% loan. So you don't get charge interest, you don't gain interest. But the key is, if you watch some of my other videos, the real magic, the real power behind infinite banking, especially when you use it right, is the ability for your money to compound over here while you only pay simple interest over here. And simple interest is cheaper than compounding interest. What's simple interest? Anytime you pay on any kind of loan, you're paying simple interest, especially when you pay your principal and interest payment. Like if you have a mortgage, that's simple interest. As you pay on the mortgage, if you've noticed, more and more gets paid to principal, less and less to interest. That's not a magic formula. That's not like a way that banks are ripping you off. It's just math. As you pay that loan balance down, you are paying less and less in interest, even though it's the same interest rate. Same thing with the loan rate on the life insurance. If you have whole life charges it separate. They do it separate. They have the interest rate that you have, that you pay the insurance company, but then you're also earning money from the insurance company when they pay you the money on that full dividend. That's the difference. That's something that most index universal life does not allow you to do. And even for the few that do allow it, again, I'm really nervous to even use it for myself. In fact, I canceled my own index universal life policy for this very reason. I didn't want to risk the fact that the markets wouldn't return what I hoped it would, or two, that they get more expensive over time. I didn't have to worry about higher costs of that insurance on that money. And then three, I don't trust insurance companies. By the way, do you know that when I used to sell those index universal life policies, did you know that some of the caps were anywhere from 12 to 17%? But over time, they've actually lowered it now to like 8 to 10%. So all the numbers we were showing back then were based on if they didn't change the rates. But insurance companies can change the rates on you at any time. They can change the floors, they can change the ceilings, and really, you don't have any predictability. Where with whole life, they're kind of boring. And to me, I've learned over time that boring is sexy. The more boring it is, the more sexy it is. I think that's why my wife thinks I'm so sexy. Anyways, another point, but that's the thing, is guys, it's really true. You want something that you can count on and that it actually works every time. So in my opinion, guys, if you're gonna use infinite banking, don't use the IUL. IUL, in my opinion, is just not that compatible with infinite banking. Whole life insurance, a lot more predictable, it's a lot easier to use, plus the returns sometimes are just as good, if not better sometimes, than even the IULs. Again, I can't promise you anything, I don't know that for a fact, but I would say more times than not, you're gonna see that whole life is gonna work out for you, which is why I use it for myself. I use it for my own business investments as well as my own investments that I use for real estate. It's the thing I could count on, I could trust, and I know it's gonna work to give me that ability to make money in two places at the same time. Now, if you wanna figure out how that can actually work or what that looks like, if you wanna see how those numbers work, you can always book an appointment with our insurance specialist to see what it looks like in your situation. Go to moneyripples.com, book a call with him today.